Welcome to Buy, Hold, Sell. I'm Ben Clark, and today we're going to do a wrap of reporting season. It's been a really busy couple of weeks. We're getting close to the end of it. I'm sure we're all looking forward to a break, but before we do, we've got Andrew Mitchell from Ophir and Jun Bei Liu from Tribeca. Jun Bei, I might start with you. Sort of overall impressions of reporting season, maybe a bit of an overview of the market generally, defining themes that you saw coming through.
Yeah, look, we quite like this reporting season because we feel the company that delivered good result, good outlook, have generally been beat up, whereas the company that delivered disappointment, no matter how cheap they were, they continue to get sold off. So I guess one of the theme that coming out of reporting season is that there's been a lot of value traps, and it works on both sides. Yeah. Some of the examples, such as the borrow that it was cheap, and then the savage reaction to the share price was down 20%, and on the upside was, the tech companies such as WiseTech and the Afterpay that delivered to expectations with strong growth outlook. Share price all rallied away.
Yeah, I think that's a pretty good summary. But Andrew, have you got anything you can add to that?
Well, from our point of view, maybe I won't disagree, but I'll come from a different tack. We found it actually quite frustrating. We felt that we've done as well as we have in past reporting seasons in terms of forecasting the earnings. But the 6 weeks of trading in July has been really what's taken stocks either skyrocketing skyrocketing that way or falling through the floor the other way. So obviously the retailers, you saw JB Hi-Fi, super cheap, Livisa, 7 weeks, good trading. The market really catches on to that. But then we've had other stocks that have given weaker outlooks, if you like. So like a Cleanaway, which has always been quite conservative and has done so well for so long, and has been punished significantly. So we've found it a bit harder this reporting season compared to the previous reporting seasons. But hopefully it all clears.
Work itself out
exactly
as we
right.
go into the end of the year. And added complexity, I reckon, this time round has been. We've had the big macro stuff going on, the Trump tweets, fair bit of volatility in overseas markets, to a lesser extent locally. How have you sort of handled that on top of, because do you feel like, there's a bit of fear, bit of gloom coming back, but a lot of the CEOs we sort of heard from, I didn't really get that message coming through. Do you think there's been a bit of a disconnect?
I agree. Well, I think maybe the companies that have performed well to date, they were more conservative, we saw. Yep. They didn't need to be. They didn't need to be super bullish because they've always delivered. Where maybe some of the companies, not that it's done badly, but a realestate.com and a Domain, they're saying, oh look, buyer activity is coming back. So we're seeing pockets of optimism there. And as the retailers I mentioned, the super cheaps, JB Hi-Fi's, Livisas, also all talking about more positive comps. And the retailers really caught a bid this reporting season on that sort of optimism, tax cuts and the likes. But at the same time, maybe you look at the builders, and we spoke about Boral before, Adelaide Brighton, Reliance, there are pockets of still, I guess, concern in that resi construction part. Yeah,
which is more sort of locally focused, I guess, because our housing market's had a bit of a trickier time. Jun Bei, how did you feel it matched up? We had some pretty nasty headlines, $24 billion wiped off the share market, but it felt pretty consistent from a lot of companies that presented.
Yeah, look, we certainly feel so, but the commentary out of the more international earning-facing companies, we have heard a bit more caution in terms of Brexit impact as well as the tariff impact. Yeah. Some of the retailers, so Breville talked to it, but smaller impact. But then, of course, Reliance actually got hit on both sides, both the tariff impact as well as the Brexit uncertainty. And it's very difficult for those companies to really, companies such as Reliance, to really forecast properly of what it might, what the impact might be given the Brexit. So that impact, but it's only on certain pockets. And I think quite rightly, Andrew touched on before, is the domestic segment is interesting because retailers are talking to the green shoots, whereas the builders are actually still in a downgrade mode. But it's quite simply, heading into reporting season, we knew people were way too optimistic with the builders because, any improvement in the housing market will take at least 12, 18 month time before we see the bottoming in any of those activities. So it's just way too early to pile into those names. And it's quite pleasing at the reporting season, we see that investors realized, and the reaction is quite rational. But of course, there's overselling and all of that. But reaction is quite rational based on what the earnings were.
Yeah. And so going into the month, how are your portfolio positioned? And has there been any sort of changes that you've made to it, or do you feel you will make to it coming out of August?
Look, on the hindsight of performance, that we put positioned strongly into this reporting season. Look, we just stuck to, we held the companies that's expected to deliver earnings upside relative to expectations, and we shorted the companies that's going to disappoint. We pay a lot of attention to how expensive they are, because the more expensive you are, and the more important it is for the company to meet that expectations. There's a few examples of stocks that actually fell meaningfully when they missed marginally. One of the examples is the Cleanaway. The result itself was actually okay. They missed a little bit, but there is a bit of a downgrade for next year, but because it was expensive, so share price fell quite a lot. Right. So that is the what we watch when we're heading into reporting season. Coming out of it, I don't think we'll make much changes. I think things worked as they expected.
Okay. And Andrew, it sounds like you found it a little bit more frustrating. Is it a matter of staying the course and sticking with the names that you've got and waiting for the market to catch up to them, or is there some changes you feel you'll make coming out of it?
No, we haven't made any big changes. We feel that we accurately forecasted where the businesses are, and they're taking market share and they're growing. We're not so much taking sector bets, if you like. We're looking for businesses that are structurally growing, that are taking market share, have new products and the likes. So it's hold the course at the moment.
That's good. And this, there was almost a fever pitch leading into the earnings period of, the really expensive stocks, they're going to get hit at some stage and they're too expensive, the wax, etc. And you're better off looking at cheaper areas of the market, valuation-wise, because we've just seen those expensive stocks are roared ahead, and as Jun Bei was saying, a lot of the cheaper ones have come back even further. How do you see the market valued? It's a bit of an arm wrestle in there.
We think that the big mistake that a lot of people are making is they're looking at historical PEs or where the market's traded previously. And what is not happening is comparing, I guess, where interest rates are and what that means for valuation. So if you look at 10-year treasuries in the fixed interest market, they're trading at 50 times PE with no growth. So if you're a company that can show that you can grow no matter what, take market share, grow into big markets, there's a wall of money that's looking for these businesses. So these quality businesses that trade on big multiples, we don't see, while interest rates are further falling, that they're really going to get hit hard unless they miss expectations, of course. So while we're not chasing these high valuation businesses or these high growth, high valuation businesses, I'm not particularly concerned that the end is in sight for these businesses.
Yep. Okay. And anything you can add to that, Jun Bei? It sounds like you've been on that side of the trade, regardless of a bit of the fear or the concern that was out there?
What makes you think that? Look, I firmly believe that this is a time where you actually do manage the portfolio risk. It's important you have a diversified portfolio, and when you do have growth stocks like we do, we manage that downside risk. We actually reasonably neutral. In terms of our portfolio average PE, is not very different from the market. Market's sitting at about 17 to 18 times. It's not very different. How we manage it is through short. For example, if we love a couple of tech companies and we position well in them, but we do short others where we feel it's just way too expensive. And so tomorrow, if NASDAQ fall 20% on the back of Trump tweets or anything, I won't worry, because the tech that I hold will be a better tech, a better quality company based on fundamental research, and the ones I short should be the worst off company. So in that environment, I should net still do better. At the same time, I hedged off my risk. That is a macro risk I can't control.
Okay, well, I think that's a great wrap. How you're positioned now and how you're going to position over the next few weeks will probably really have a big influence on the next 6 months of performance of your portfolio, and that's some great advice